Welcome everyone to the Chartered Accountants Worldwide Network USA webinar, What's Happening with International Financial Reporting Standards, presented by BDO. My name is Geoff Aldridge. I am the president for the Chicago chapter of Chartered Accountants Network USA, and I'm also a corporate tax principal with BDO. Before we start today's webinar, we need to run through a little housekeeping. So first up, a handout should be available. You can download this from the control panel. Secondly, this webinar is CPE eligible if you have requested it. So to qualify, you will need to answer the polling questions that we will be asking during the webinar, and you need to answer, let's say, at least 3 of the polls and attend for at least 50 minutes to qualify. The format of this webinar is a 60-minute presentation, including this introduction. If you have any questions, please note them down in the Q&A tab on your control panel. We will also be recording the presentation, and we'll make the recording available on the Chartered Accountants Worldwide Network USA website. At the end of the event, when you exit and take our short survey, do let us know what you thought about the webinar. Plus, let us know if you want to connect with any of the presenters. Our learning objectives today are that after the presentation, you should be able to understand IFRS for SMEs and accounting in times of uncertainty, particularly with regard to impairments, fair value measurements, discount rates, going concern, judgments and estimates, and disclosures. Discussion of these areas will be followed by a wrap-up session and any audience Q&A. And now let me hand it over to Andy to run the first poll. And while he's doing that, I'll introduce the team of presenters here as well. Okay. So as I mentioned earlier, I am a tax services principal at BDO. I focus on helping foreign and/or private equity owned US companies with their tax needs. And before I introduce the first of today's speakers, I also want to say a couple of very brief words about BDO. BDO is the 5th largest accounting firm in the world. We offer a full suite of tax, assurance, and advisory services from more than 60 offices across the US and over 160 countries worldwide. In the US, we are also very proud to say that in an age of private equity ownership, we are also a distinctly different employee-first, employee-owned business. Our presenters today are part of our global services group, specifically within our IFRS team. The team helps clients with conversions to IFRS, specific technical reporting issues, and general ongoing reporting, as well as supporting BDO's audit and assurance practice with reviews of IFRS review reports and opinions. They are also very well connected with our global IFRS reporting team that has a wealth of resources and brings together our experience from around the world dealing with the practical application of IFRS, particularly with regard to implementing new standards. From that team, I am joined today by Andrew Moore, who is a director in that group, Oscar Ayala-Murillo, who is also a director in that group, and Kishan Kumar, who is an associate director from the same group. And now let me hand over to Andy.
All right, thanks, Geoff. So we got the first result poll in. I think it says 80%, over 80% of you have need knowledge of IFRS in your day-to-day work. So let's go on and talk through our agenda. I think the learning objectives that Geoff touched on pretty much cover it. So we're going to do a section on IFRS for SMEs and the updates that are coming in that respect. And then the main focus is going to be on accounting in times of uncertainty. So Kishan, Oscar, and I will each do a section on that, talking about different topics: impairments, judgments, going concern, discount rates, disclosures, things like that. All right. And so with that, I'm going to hand it over to Oscar.
Well, thank you, Andy. I appreciate that. And good morning and afternoon to everyone, or evening that is listening to us today. And let's discuss IFRS for SMEs. And we decided to include this topic because there's a substantial revision to the standard, or there was a substantial revision, which was published in February of this year, and also because that's a standard that is widely used across the globe, and we believe it will be very important for our audience to know and understand some of the key changes that have been introduced in this third edition. But before we go into the details on the changes, and it's also important to just understand or sort of bring two key points. The first one is the IFRS for SMEs was designed basically, or was a standard that was designed for entities that do not have public accountability, publish general purpose financial statements for external users. Therefore, for that definition of SMEs sort of goes beyond the size of the entities, but also the application is also based on the nature of those companies or the entities that we audit or have. And the second point also is on the applicability of the standard itself, as entities are also subject to the laws and local jurisdictions. So, for example, many countries require statutory reporting, and each of the countries will sort of individually decide whether that IFRS for SMEs is an acceptable basis for such reporting. And this is the case, for example, in South Africa, where they sort of the use of the full IFRS accounting standards for public reporting has been replaced by the local GAAP, which is IFRS for SMEs, for accounting standards. So it is quite important for companies to really understand on a country basis where that SME accounting standard is allowed or required for statutory reporting. And usually a common question that comes out of these applicability is if a parent entity is required to present consolidated financial statements in accordance with full IFRS, can the parent entity present those separate financial statements in accordance with IFRS for SMEs? And we go back to that public accountability notion or definition, which may present separate financial statements, right, in accordance with SMEs, even if those financial statements, the consolidated financial statements, are presented in accordance with full IFRS, but just keep that definition in mind of public accountability, right? And I think we sort of discussed that a few quarters back on the IFRS 19. Okay, next slide, Andy, please. So as we know, IFRS for SMEs is designed to sort of be a stable, sort of standalone standard, and the IASB has performed a few updates since the first edition in 2009, and usually the IASB sort of maintains that through periodic reviews. It will not amend a section at a time, so it will just have an aggregate of different topics and then propose changes to these sections. And that usually will happen, as we see it on this slide, kind of years apart. And as you can see on this slide, basically, the last meaningful update was in 2015, with the related amendments being effective on January 1st, 2017. So the standards, including IFRS 9 for financial instruments, IFRS 15 for revenue from contracts, 16 for leases, and 18 for presentation and disclosure of financial statements, were not considered in an update of the SME for accounting standards in 2015. So now, moving forward in 2020, there was a comprehensive review, and the IASB sort of started asking stakeholders whether the SMEs in relation to these topics should be updated for changes compared to IFRS full accounting standards. And they look at all the requirements in full, and they had not yet been reflected on the SMEs. So as a result, the IASB published this third edition, earlier in the year to incorporate those key changes for those topics and changes to the standards. Next slide, Andy. So this update on the SMEs accounting standards will sort of take effect for annual periods beginning or after the 1st January 2027. But of course, companies may choose to start using those as soon as being published, which was in February of this year. Ultimately, the IASB updated the IFRS for SMEs to improve the information that is provided to users of SME financial statements, while sort of maintaining that simplicity of the standards. And we'll see that as we go forward during the presentation, and focusing on the clarifications and improvements of the requirements for the 1st edition. And the 3rd edition, which we'll talk about, incorporates amendments that are more substantial across many sections. As such, it is, I think, very important for companies to start assessing that the potential changes and the potential impact as early as possible. So prepare an analysis against the new requirements before they become effective on January 1st, 2027. Next slide, Andy. And as you can see on the slide, the goal is to provide a sort of simplified version of full IFRS accounting standards. And throughout the 3rd edition, the SME standard sort of reflects the enhanced alignment with the full IFRS accounting standards, while incorporating sort of targeted simplifications to ensure that it sort of remains relevant, that is based on users' needs, and there is also a cost-benefit consideration to the change and the updates. So, for example, it will omit topics that are not relevant to SMEs. It will remove some of the accounting policies options that are available for full IFRS accounting standards. It will simplify the recognition and measurement requirements. It will reduce disclosures and also simplifying the language. However, still keeping some of the same sort of requirements in some way to full IFRS. Next slide, Andy. And now let's talk about it specifically on the major amendments that were included in this 3rd section update. And keep in mind that we have included on the slide here is sort of extremely high level, right? But if this is relevant to you, then we encourage you to just please consult a more detailed guidance, and we have all the resources that we'll give you at the end of the presentation. Now, one of the key changes relates to section 2 for the concepts and pervasive principles, and this is a complete revised section, and this new section will help SMEs when applying judgment in developing accounting policies. And it sort of introduces also a new concept of measurement, presentation, and disclosure, and guidance on derecognition. It also updates the definitions and recognition criteria for assets and liabilities, and it retains the concepts of undue cost of effort. The second key change is in relation to section 9 of the consolidating and separate financial statements, and introduces a single basis for assessing control and removes the 2 previous models. And that single model now that is being applied will improve that comparability between the consolidated financial statements being prepared, applying the standard. And the IASB also applied that alignment approach to IFRS 10 on the consolidated financial statements and IFRS 11, and incorporated those changes to section 9, 14, and 15 of the new revised standard. And the 3rd key change relates to section 11, which relates to basic financial instruments, and introduces a principle for classifying financial instruments that will make that classification of financial instruments a lot easier. So essentially, it will reflect changes that have been made to reflect the requirements of IFRS 9, but with simplified requirements and exceptions in terms of disclosures as well, and fair value measurements. For example, introduces a supplementary principle for classifying debt instruments based on their contractual cash flow, new requirements for issued financial guarantee contracts and introduces a new disclosure requirements, which provides an improved information about SMEs' liquidity and cash flows. Next slide, Andy. The other key change is sections 12. Go back one, Andy. There we go, perfect. On the key sections of fair value for section 12, which brings together the requirements in the fair value measurements and align these requirements with those in IFRS 13. The next change is also section 19, which relates to business combinations, which also introduces new guidance to align with IFRS 3, an updated definition of a business, introducing new measurement requirements. And last but not least is the key change of section 23, which is revenue from contracts, which also has been aligned with IFRS 15. And with this update, the SMEs will be required to apply a single comprehensive framework in determining revenue recognition. And of course, the impact will depend on the individual contract complexities. However, understanding of these new requirements for the accounting disclosures will be essentials for all SMEs. And apart from all the changes that I just mentioned, there's a couple of many sections that sort of develop or feature improved guidance and clarifications which will help SMEs accurately present or represent the economic activities of their financial statements. So we talk about things like supplier finance arrangements, cash settled share-based payments, defined benefit obligations, as well as foreign currencies. And next slide. And here, as we mentioned at the beginning, right, IFRS 16 leases, the 14 for deferral accounts and cryptocurrency are a few topics that the ISB has selected not to consider yet in this set of revisions, but that will be deferred until the next comprehensive review. So hopefully that will be happening within the next 3 years or so as we look at the timetable, right? And the next one. And as we talked about, here are a few resources where we basically have a detailed explanation of all the sections that were updated. So if you want more details, you can click on each of the resources that we have that are given by our Video Global, and we're planning on publishing a new update for SMEs later this year. And with that, I'll pass the presentation back to Andy. Thank you.
Okay, so I think we've got another poll here, so I'm going to launch that. Just give you a moment to take a look. So the IFRS for SMEs accounting standard is a self-contained, globally recognized standard, permitted in 85 jurisdictions around the world. So is the answer to that yes or no? Give you a few more seconds to get through that. All right, so I'm going to close this down now. As you can see, 98% of people were right. So that yes is the correct answer there. So now let's move on to accounting for in times of uncertainty. So we're going to focus a good chunk of the session today on this section. So we're seeing lots of uncertainty in the global trade and environment at the moment. So in early 2025, President Trump announced tariffs on imported goods from numerous countries. And so the amounts and effective dates of those tariffs have shifted, as we know, and they're continuing to do so. And that's just created a lot of uncertainty in itself. And there's been associated market volatility that's been caused by that. So not only has the US been implementing these trade rules, but also governments across the world have also been offering reciprocal tariffs or adjusting their trade policy as a result. And so there's a lot of uncertainty that's caused by this, and we need to think about what we're going to talk about today is the accounting implication of that. So then if we think back to earlier in the year, as a result of the tariff activity, stock prices of US publicly traded companies did fluctuate, and there continues to be movement. And consumer behavior has changed as they're considering decreasing their discretionary spending or adjusting that in anticipation of tariffs. And so when we think about that from a company perspective, we need to think about the tariffs and how that market volatility may expose the entities to new risks and disruptions to their supply chains and increased costs, and then think about how that change in demand and supply may affect financial projections and asset valuations. So as a result of those direct and indirect effects of the tariffs, it's important that we think about the variety of impacts that could have on the financial statements. So if we think also about the uncertainty from tariffs, there's also uncertainty because of conflict around the world. We're seeing that in the Middle East and in Ukraine in particular, which is also going to affect supply chains and international groups too. So we're going to talk about a number of examples and ideas as we go through this session, but obviously you need to tailor that to your own company's facts and circumstances as you prepare and think about the implications here. Okay, so firstly I want to talk about impairments. So tariffs can increase the cost of production, reduce the demand for goods and services, and have other indirect effects which may increase the costs and the risk of impairment of non-financial assets. Thinking here about things such as property, plant and equipment, right of use assets, intangible assets and goodwill too. Furthermore, entities can be affected by their customers or suppliers or their investments being in areas that are affected by conflict, and there may be impairment risks as a result of blockages in the supply chain and actual direct damage to the investment's assets, or a reduction in demand if selling into affected areas. So for example, an entity that exports a significant amount of goods to one or more foreign jurisdictions that have increased their tariff rates for entities importing those goods may see demand for its goods and services decrease as they become less competitive from a price perspective from a customer. So entities may also face increased import costs if they're bringing products into the US as well. And so we just need to be cognizant of those changes and the implications they may have. So just to pull it back directly to the impairment standard, so IAS 36. IAS 36 requires an impairment test to be performed annually for goodwill and any indefinite lived assets. So that test has to be performed for the assets in that category. And then impairment tests on other assets are only performed when indicators of impairment are present. So on the slide, we've pulled out some of the relevant sections from IAS 36 and highlighted the ones that could be triggered by conflict or tariffs, leading to the need, if the trigger is present, for a quantitative impairment analysis to be prepared, and which obviously is more time-consuming and may lead to adjustments to the financial statements. So entities should exercise greater caution and appreciate the increased likelihood of the existence of impairment indicators being present, especially if we think about any entities that have got significant amounts of revenue that are derived from a jurisdiction where tariffs have been imposed or on goods and services. A significant uncertainty concerning whether tariffs are going to cause increased costs from a purchasing perspective, and then thinking about any implications from a supply chain and the risks that might cause knock-on effects on ability to produce, but also ability to deliver on a timely basis to the customers. And then also thinking about, okay, we've got these increased costs, but are we actually going to be able to pass those on to the customer? All right, so I'm going to bring a couple of scenarios we're going to talk through here. And Oscar's going to step back in and help me with these.
And Andy, I think some of the scenarios I think that we have here have come up from also experience and dealing with a couple of engagement teams as well that have asked those questions, right?
Yep,
and
that's right.
The first one is, if the entity does not export a significant amount of goods or services that are subject to those tariffs, and is also minimally affected by rising import costs, could that impairment indicators exist in this case?
So yeah, good question, but I think it requires careful consideration. So impairment indicators could certainly exist there. So whilst they may not have a direct impact, there's going to be, or we're expecting that there's going to be an impact on the global economy and that may result in downturns in the economy more broadly, or knock-on implications to the costs and things like that. So, for example, an entity may not be directly affected by the tariffs, however, they may still experience reduced demand for its goods. Maybe if we see a spate of or higher unemployment, or individuals decide to make lower discretionary spending, that could impact your revenue or your costs, depending on the nature of the business. So yeah, I think the key is to think about not only the direct impacts, but also the indirect impacts that might have.
Yeah. Okay. And the second question that we receive as well is that if tariffs have not been enacted by the reporting date, can they be ignored in the calculation?
Yeah, this is an interesting one. And so the answer there is no. So it's not appropriate for an entity to base its estimates for its value in use solely on the tariffs that are in force at the reporting date. So IAS 36 requires value in use to be estimated based on future cash flows that the entity expects to derive from the assets. And so that could be affected by changes in tariff policy going forward. So if we think about IAS 36, it requires the cash flow projections be based on reasonable and supportable assumptions that represent management's best estimate of the range of economic conditions that exist or will exist over the useful life of the asset. So where there is significant uncertainty, just doing one cash flow forecast probably isn't going to be the best methodology. And so I think it's a good idea to map out and to model multiple scenarios and then apply a weighted average across based on likelihood across several of those scenarios in order to give a best estimate that factors in the potential for tariff and the impact that they might have. But you can have an upside and a downside, of course, on that too.
Yeah. Okay. And the last question, Andy, it's that if tariffs have been enacted by the reporting date, do entities still need to assume that they will endure for the remaining useful life of the assets?
Yeah. So this is like a not necessarily. So as I just talked about, IAS 36 is requiring reasonable and supportable assumptions to be applied. And so you may think, if they're in place now, you need to make an assessment as to whether you think they're going to be in place for the whole life of the asset, or whether there's, in all likelihood, a weighted average of several scenarios that probably need to be used to justify those assumptions. Okay.
Okay.
Appreciate it, Oscar. Thank you. So then let's talk about the key considerations when performing an assessment of the impairment of non-financial assets. And so I think these would be the key takeaways in the event that there's a quantitative analysis that needs to be provided. So if we think about the key things we need to think about is determining an appropriate discount rate, the inputs that will be used in a value in use calculation. So making sure they reflect the expectations of the future cash flows, kind of as I said, thinking about potentially modeling a few scenarios and applying a weighted average to those to give a realistic and thought through analysis that factors in potential tariffs and those being rolled back perhaps, or those being rolled out more aggressively in the future. And then I think the final piece is making sure that there's high quality disclosures in the financial statements. So particularly around the key assumptions that you've made around, the length of the useful life, the likelihood that tariffs will be applied across the life, as well as things such as your normal kind of revenue expectations and your margin expectations too. Okay, so let's run one more poll. So in the current world trade environment, there is lots of uncertainty. Also, I guess the question is there lots of uncertainty as a result of tariffs and armed conflicts? So launch that. Everyone's in the yes camp so far, which is good. I'm going to close it up now. So everybody said the answer was yes, which I agree. I think we're back now. All right, so let's talk about fair value measurements now. So now we've covered impairments, let's branch out a bit and think about how assets measured at fair value might also be affected. So tariffs and the general macroeconomic uncertainties may lead to an increased level of uncertainty with respect to inputs used for the determination of fair values. So entities need to consider the effect of the current macroeconomic environment when thinking about fair value measurements, particularly if you've got level 3 inputs and the associated disclosures that you've got with those. So if we've got tariffs that are enacted at the reported date, entities do not have to automatically assume they're going to endure when estimating the fair value, which goes back to what we're talking about with the value in use calculation from an impairment perspective. So IFRS 13 defines fair value as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So the market participants are buyers and sellers in the principal or most advantageous market for the asset or liability. Market participants would not necessarily assume that tariffs are going to endure for the entire economic life of the asset. And so estimates of the fair values must consider the assumptions that those market participants would make and the associated uncertainties that they would consider. So then switching topics a little bit, so we're talking there about level 3 investments really, but if you've got level 1 inputs, just remember that if the values that would be used for those are based on conditions that existed at the balance sheet date. So if you've got like a listed investment in an equity interest, for example, you would just be taking the stock price at your balance sheet date. You wouldn't factor in any future significant declines in the market price. But again, we're looking at, in all this, we're thinking about IAS 10 and events after the reporting period too, as well as IFRS 13. Okie doke. So then let's talk about discount rates. So we've already considered some of the IAS 36 impairment and the IFRS 13 fair value considerations, but one factor that affects both those topics and then others too is the discount rate that's going to be applied. So a number of IFRS accounting standards require discount rates to be determined. And so I just wanted to kind of run through what some of those are, because again, they could change because of these macroeconomic effects. So we've got the impairment of assets, which we talked about, and so the discount rate that you use in those calculations usually reflects the current market assessment of the time value of money and the risks that are specific to the asset. And normally that's often a pre-tax number. And if we think about anything in relation to employee benefits, so you'll be looking there at a discount rate that looks at a market yield on a high quality corporate bond, whereas on IFRS 16 leases, we're going to be looking at an incremental borrowing rate. So assuming that there's no implicit rate available for a lease, we usually go to the incremental borrowing rate. And then IAS 37, the provisions and contingency standard, talks about a rate that reflects the current market assessment of the time value of money and risks that are specific to a liability. And so similarly with IFRS 2, there's a different discount rate or different considerations, and a risk-free rate is often used in option pricing models such as Black-Scholes. So I think definitely discount rates is an area to consider carefully when you're going through and consult with a valuation specialist as needed. So yeah, let's just talk about a couple of key reminders in this area. So when estimating the fair value or the value in use, we've got to avoid double counting or omitting the effects of some risk factors. So IFRS 13 and IAS 36 both make reference to this. So IAS 36 notes that a discount rate should include the risks that are specific to the asset for which future cash flow estimates have not been adjusted. While IFRS 13 notes that the discount rate should reflect assumptions that are consistent with those inherent in the cash flows. So if the cash flows are adjusted for certain risks, then the discount rate should not reflect that risk. So there's no double counting. IAS 36 and 37 require the use of pre-tax discount rates. Entities often use a weighted average cost of capital as a starting point for determining the rate to be used. But again, just to note that a WACC is usually a post-tax rate, and so there's a need to think about a pre-tax adjustment to make that comply with IAS 36 and 37. As I said, important to think about, to consult with a valuation expert. Also when thinking about inflation and how that is reflected in the cash flows that you've used and the discount rate that's applied. I'm then going to hand over to Kishan to give us some insight on going concern.
That's me, Andy.
Oh, sorry.
So, That's fine, not a problem. All right. So let's talk about going concern and what Andy was alluding, right, of everything that has happened for the past few years and the continuing uncertainty in the economy that is arising for multiple reasons. So we expect investors and regulators and auditors to be looking at how companies are navigating the going concern basis and the disclosures around it. So we're going to discuss a few key considerations when determining whether or not there is a substantial doubt of for going concern and what we should be thinking about from a disclosure perspective based on IAS 1 and IAS 10. And the first consideration is sort of paying close attention to certain factors that may indicate material uncertainties. So for example, factors that are affecting primarily the company's liquidity, cash on hand, significant reductions in revenue as a result of reduced demand for their goods, services or services globally due to effects of tariffs, for example, or perhaps a significant rise in debt where certain covenants are not being met. So therefore, management also needs to consider this wider range of factors before they sort of conclude whether preparing financial statements on a going concern basis is appropriate. A second important consideration is related to management's assessment and whether management is taking into account all available information about the future, which is at least but not limited to 12 months from the end of the reporting period, or be 12 months from the date on which the financial statements are authorized for issuance, depending on the jurisdictions, regulators, or the auditing standards that are being applied. However, it's important to mention, though, that the time period longer than 12 months is not inconsistent with the requirements in IAS 1, which sort of establishes a minimum period, but not 12 months. But 12 months is not really an absolute period. And I also think that it's important to emphasize that going concern assessment is not as an annual assessment. This assessment is both done for the 3 annual or in an interim financial statements that are being issued. Okay. Another key point to consider should be an event or events that occurs after the reporting period that will result in an entity not longer being going concern, and are these events being considered as an adjusting event? And right now, in a sort of rapidly evolving economy environment, it is critical to consider that information that is available until the date on which those financial statements are authorized for issuance. So for example, we're talking about events that perhaps the entity is intending to liquidate the business or to cease trading. And the final point to that will be also the consideration of going concern being assessed at the group level and not just at the subsidiary levels as well. Okay. Next slide, Andy. All right, so let's now move on to disclosures territory and let's navigate through this flow chart based on IAS 1. And IAS 1 requires management to assess the entity's ability to continue as a going concern, and defines going concern by explaining that financial statements are prepared on a going concern basis unless management intends to liquidate the entity or to cease trading, or has a really no realistic alternative to do so, basically liquidating. So as such, the first thing that we need to ask is whether the going concern assumption is appropriate. And in essence, are the financial statements prepared on a going concern basis? If the answer to that question is no, then simply entities need to disclose the fact, right? The basis on which the financial statements are being prepared, and the reason why the entity is not regarded as a going concern. However, if the answer is yes, right, to that question, we keep moving down the flow chart and question whether there are any material uncertainties about going concern. And are those any significant judgments as well involved in this assessment? And if the answer to these two questions on the material uncertainties and also significant judgments is positive, then we go through basically a sort of thinking about, right, of what sort of disclosures are being required based on the standard. However, if the answer is no, then the entity will only have to describe the basis of the preparations, and there is no specific disclosure requirements related to going concern. And we'll go through a few examples as we go through the presentation. But the key point here is that any material uncertainties, significant judgments, assumptions in the estimation process must be disclosed in the financial statements. The next slide, Andy. Now, let's have a look at a few scenarios where circumstances could range from what an entity is profitable and has no liquidity concerns to what is a close call to prepare financial statements on a going concern basis, even after considering any mitigating actions that are planned by management. So scenario one, pretty simple, right? It's an entity that has profitable operations, no liquidity concerns. As such, the basis for the preparation is ongoing concern, and no specific disclosures are required. Scenario two, there's a substantial doubt of going concern. However, after the consideration of management, the feasibility and effectiveness of those actions it plans, management concludes that the material uncertainties are expected to be mitigated. It is also understood that these actions that are planned by management involve significant judgment. Then the disclosures requirements in paragraph 122 with IS1 will also apply to the judgments made in concluding that no material uncertainties, and those judgments will have to be disclosed in the financial statements. For scenario three, management concludes that there are material uncertainties related to events or conditions that also may cast significant doubt upon the entity's ability to continue as a going concern. So in addition to those disclosures that we just described for scenario two, then paragraph 25 of IS1 requires an entity to disclose those material uncertainties as well. So in essence, when we're looking at scenarios 2 and 3 together, we're not only focusing on the disclosures, management disclosures regarding the judgments about going concern, but also on the assumptions that it makes about the future and other major sources of estimation of that uncertainty at the end of the reporting period that could result in material adjustments to the carrying amounts of assets and liabilities within the next financial year. And the scenario 4, based on IS1 paragraph 25, it requires the entity to disclose the fact that financial statements have not been prepared on a going concern basis and the reasons of why the entity is not regarded as a going concern, as well as disclosing the basis of the preparation of those financials, which could be on a liquidated basis, for example. Next slide. Now here we have a few points to remind our audience that what should be expected if an entity is experiencing similar characteristics of scenario 2 and 3, as just discussed. And I just went through a review of a set of financial statements where there was a significant doubt of going concern, and management identified mitigating factors. However, the company disclosures was limited to only listing 3 mitigating factors. One factor was committed to financing, the other one was cost reduction plans, and the third was funding from the parent company. But in management's mind, they thought that they had met those disclosure requirements, by just saying that they have these 3 mitigating factors. But as we can see from what we just discussed and here on the slide, the company clearly sort of missed that few key disclosures as to, well, one, how is the entity going to meet those liabilities over the going concern assessment period? What are the actual cost reduction plans and the quantification of those assumptions? And if they're going to be funded by a parent company, what's the timing and the extent of that support? So as you can see, it just goes beyond just basically just saying, yeah, we have plans, but do we need to disclose those details on the plans? Yes, you do. Next slide. And here we have a few strong examples where management provides transparent, quantified assumptions along with the explanation of how these assumptions were determined. And in cases involving multiple scenarios, which I'd included here on the slide, there are entity-specific assumptions to sort of help understand those users of the financial statements, how the entity is planning to meet its obligations over going concern assessment period. And the next. And here we have included a few links to resources for your consideration and reading. So I believe now we move on to the judgments, right, of significant uncertainties. There we go. Okay. So on significant judgments and estimates are involved in sort of a number of areas, financial statements, such as impairment assessments, fair value measurements, inventory valuations, etc. So in times of uncertainty and adjustments where we're talking about, estimates and estimation uncertainties had even more a critical role in the accounting. And sort of given that rapid evolving circumstances, significant judgments and estimates also need to be assessed, updated, and monitored continuously to ensure that they reflect current circumstances. So companies need to revise their assumptions, valuation models, consider multiple scenarios and possible outcomes. So for example, sectors that are particularly affected by increased tariffs may need to consider those multiple scenarios with different assumptions, cash flow projections and estimates, and recoverable amounts of impairment analysis on non-financial assets, for example, right? And here in this slide, we point out to IAS 1-122 and IAS 1-125, which provide those requirements for disclosure of significant judgments and significant estimates. And now in terms of judgments, management should be disclosing those that have the most significant effect on the amounts recognized in the financial statements. And in terms of the estimates, management must disclose the assumptions and other major source of estimation uncertainty that have a significant risk of resulting in a material adjustment. Next slide. Now, we have listed a few examples that will sort of meet that requirement at IAS 1-125, which explicitly requires a disclosure of significant estimates and major sources of estimation and uncertainty in matters that help users of those financials to understand the judgments that management has made about the future and other resources or sources of estimation uncertainty. And it's also good to clarify that one thing, that there's many ways to disclose those significant assumptions or the significant estimates. And they could actually disclose that in a related note itself, rather than in a separate note of all the significant estimates. Or there's some companies that also may aggregate a list of all significant estimates made and cross-reference to the applicable note containing that information. So there are many ways to present that within the financial statements. Next. In terms of significant judgments, there's some expectations that are set out by regulators for significant judgments to separately identify the judgments that do not relate to a source of estimations uncertainty and those that do, and to give detailed descriptions of the specific material judgments made by management in applying their accounting policies. So in terms of significant estimates, we have a list of a couple of items that are expected to be disclosed in the financial statements and that we often see on comments from regulators, such as the quantification of assumptions, explanation of changes in assumptions, and providing sufficient detail in the description of those assumptions or uncertainties, and be able to those users of the financial statements to understand management's most difficult, subjective, or complex judgments. And last. All right, and to close this section, we have here a few examples that are expected related to estimates and assumptions that have a significant risk of causing a material adjustment to the carrying amounts of assets and liabilities within the next financial year. And with that, I'll pass the presentation to Kishan. Thank you.
Let's just run a quick poll here. So IS 1 paragraph 25 requires an entity to disclose material uncertainties relating to its ability to continue as a going concern. So do you A, agree with that, or B, disagree? And so 99% of people agreed. Okay. And with that, Kishan, over to you.
Thank you, Andy, and thank you, Oscar. And very good day to all our viewers. My name is Kishan Kumar, and we'll take you forward with the remaining slides on accounting in times of uncertainty that we are covering today. So the next topic we have is IS 10, events after the reporting period, and the IFRS equivalent to US GAAP's ASC 855 subsequent event. Times of uncertainty and rapid unpredictable change increases the risk that a material subsequent event will occur. Because of this, it perhaps becomes more important than ever before for entities to monitor such changes in the global economic and geopolitical environment on a continuous basis and assess the relevance of any major events to the business to identify and account for any material events after the reporting period. IS 10 is all about the timing of recognition. When did the event occur? With that, take a quick recap of what the standard says. IS 10 has the following important definition. Events after the reporting period is somewhat self-explanatory, but is defined as those events, whether favorable or unfavorable, that occurs between the end of the reporting period and the date when the financial statements are authorized for issue. These can either be adjusting or non-adjusting events. So let's take a look at what those events are. Adjusting events are those that provide evidence of condition that exists at the time of the reporting period, whereas non-adjusting events are indicative of conditions that only arose after the reporting period. Now, what does the standard require for each of these types of events? For adjusting events, the amounts recognized in financial statements are adjusted to reflect material adjusting events. In other words, the conditions arose during the reporting period, and so it needs to be accounted for in that reporting period. For not adjusting events, no adjustment is recorded in the reporting period, but the entity is required to include disclosure for both the nature of the event and either an estimate of its financial effect, or if it is not possible to estimate the financial effect at the time of issuance, then just a statement that such an estimate cannot be made. Andy, next slide, please.
Kishan, Andy is still on, but I don't know why he's not responding. And he's controlling the slides, so.
Kishan, you can talk about the next slide without it on screen. Yes.
Sure. So the next slides, we were talking about the disclosures regarding how we can discuss about the effect of these transactions. It is very important for us to understand what are the disclosures required in times of uncertainty, because the investors and financials, they are managing the high level of risk, which means that they are likely to exercise a higher level of scrutiny when they're looking at the financial statements, and particularly the disclosure which are around the nature and extent of these risk that the entity is exposed, and also around the areas of judgment and uncertainty. So the disclosures plays a really crucial role over there. And we've actually outlined some of the tips that we can ensure for having a high quality of disclosures. First, the disclosure should be clear, concise, and understandable, and it should not include immaterial information. The second and the most important is that significant management judgments and key assumptions underlying main sources of estimation uncertainty should also be clearly disclosed, including information about the sensitivity to changes in assumptions. Our disclosure should also be very much entity specific and should meet the disclosure objective of the relevant IFRS accounting standards. I mean, the entities can and should also provide additional disclosures as necessary to enable users to fully understand the impact of materials, transactions, events, and other conditions on the entity's financial performance, even if it is not explicitly required by the standards. And lastly, we all know that the boilerplate disclosure should be avoided. Focus on those disclosures that are specific to entities and relevant to the users. And then we were thinking about discussing
Kishan, Andy has technical issues, which is why he's dropped and hasn't been able to get back on. We're a couple of
Okay.
minutes from time, so you might just want to refer people to the slide deck and suggest they download it. And if they've got any questions in the survey at the end, they can write any comments and come back to you if needed. I guess if you've got any key things to add before you close, just speak to that and then pass to Geoff so he can close.